Welcome to this week's Credent Connect series, and today we really want to focus on the Federal Reserve. Not very exciting, I understand maybe that part of it, but the reality is the actions of the Federal Reserve in raising interest rates and trying to curtail some of that economic growth, as counterintuitive as that may sound, are actually posing some fairly decent benefits that we want to highlight because it will aid in that eventual contraction of the economy in what is being called a soft landing, right? A more smoothed out economic slowdown. And the four items I want to focus on to kind of gauge how is the Federal Reserve's tightening cycle is panning out actually falls in the category of retail sales, inflation, slowing labor market data, and then of course we got to tie that to the perceived or impending government shutdown. On that note, Alicia, let's start a little bit by, first of all, the tightening cycle of the Federal Reserve. Rates have been going higher, obviously. Inflation has been higher as a result. Rates are higher to try to bring that down, which is also causing the consumer to potentially spend less or maybe spend on certain key areas more so than others. Give us a broad overview of retail sales, maybe 2-3 years ago relative to the trend this year. What's happening? Are the Fed's actions working in getting consumers to spend less?
Sure. So when we think back to the pandemic, we had a lot of fiscal transfers. A lot of people were receiving excess unemployment. So we had a lot of excess savings, but consumers weren't able to go out and spend that savings. We couldn't go out to concerts. We couldn't go out and do a lot of things that we did day to day. So what we did was we stayed at home, got on Amazon and bought a bunch of goods. And so what we saw was retail sales just exploding during the pandemic at a time when supply chains were really broken. So we saw a lot of spending, and then we saw a lot of goods inflation result from that. And so what we're seeing now is kind of a shift over time. Now we're seeing a lot more spending on services. But also retail sales looked pretty good over the last second and third quarter. So still really strong, but now in October, the first print that we are seeing where there's a deceleration, which is what the Fed wants to see, happened in October. And so in this piece that we're releasing in that chart, you'll see 6 consecutive months of really pretty good growth within retail sales. And in October, we're seeing just a small decline.
That first actual positive crack, right? I know that sounds counterintuitive, but the fact that the Fed is one of its most aggressive tightening cycles in decades to seeing consecutive retail sales growth, and now we're starting to, by the way, that growth was decelerating a little bit, yet still positive. This was the first negative print in actual growth year over year. So that trend is now looking positive, and the Fed has confirmed that. On that notion of trend, one of the things that is also trending lower is inflation. Okay, and inflation has impacted Americans this year, over the past 18 months actually, at the hardest pace, at the worst pace rather, since the 70s and 80s. The reality of the inflationary backdrop has been firstly a huge function of energy prices at the beginning of this inflationary cycle, right? As Russia invaded Ukraine, the energy price backdrop added to inflation precipitously, which kind of caused massive spikes. We're seeing that trend now notably lower. And to say that we're going to get back to 2% annualized inflation is probably not something in our near future. Yet that mark of 2.5% to 3.5% inflation, that is likely the new normal over the next 5, 6, 7 years. And historically, that actually falls in line with how much, with the kind of the inflationary backdrop and the data associated with the consumer price index. The current trend has brought us down from the peaks. It is likely to remain around these levels with fluctuating segmentation of the economy of where that inflation is felt most. Certainly things that we're keeping an eye on that front, kind of gauging where we should be positioned as a function of inflationary pressures. To add a third key on that trend of how things have been trending lower due to the Federal Reserve tightening cycle, let's talk about the labor market real quick, right? The one thing the Fed cannot kill. Which sounds terrible, yet it's so true given that it's defied all odds. Talk to us a little bit about the labor market, where we were and where the trend is today.
So when we look at the labor market, it is still really strong, but we are seeing more of a normalization there. So I think the unemployment rate got as low as 3.4%. We're starting to creep up a little bit to 3.9, but the good aspect there is we're seeing labor force participation increase, which is actually a really good reason for the unemployment rate to increase. So still very strong. We're still seeing non-farm payrolls come in pretty decent, but much slower acceleration than what we saw before. And what we're highlighting here is the claims data. So initial claims, they don't look bad at all, but the continuing claims are starting to trend higher. And that just means that for those that are unemployed, they're having a little bit of a harder time finding employment. So overall, still a pretty good labor market, but we're seeing the Fed's policy working within the labor market to bring a little bit more balance between supply and demand.
Valid point. What's interesting also, looking at job openings, say 6, 7 months ago, there was roughly 1.9 to 2 open jobs per job seeker, which by the way, blows estimates out of the water relative to pre-COVID. Since the Fed's tightening cycle, we're sitting now at roughly 1.4 to 1.5 open jobs per job seeker. So to your point, it has gotten harder for those job seekers to find employment, yet really not hard enough for it to justify a systemic slowdown of the economy. And unless the labor market truly reaches some sort of catalyst for tremendous downside or excess jobless claims, it's going to be very difficult to make a solid argument that an economic recession of any kind would be severe or elongated to whatever capacity on that front. Lastly, we're going to leave you with a media kind of headline that's going to amplify even more from now until January and certainly into the middle part of next year. And that's this notion of government shutdown, right? That the headline that keeps coming up, the fact that we have postponed it now till January of 2024. We are entering a critical election year, which typically when government shutdowns and election years don't mix very well. They tend to somehow disappear. And we are certainly likely to see that come into fruition over the next 12 months. But that doesn't mean that it's going to stay out of the headlines. What we want to urge you is that making decisions on your plan, on your financial plan rather, and your investment strategies based on headline news of a government shutdown is never a rational idea, given that they are very short-lived and their impact to capital markets is often mute. Thank you.